There's been a clear divergence of price action between Bitcoin and the S&P over the month of October. We've had the rocking pump on Bitcoin breaking 32,000 and hitting 35,000. Meanwhile, the S&P 500 has been down for 13 weeks from the July top. However, it's still holding out above the October 2022 cycle low. We are 54 weeks into a new move to the upside. So in today's video, I want to have a look at something that the S&P 500 has never done throughout its entire history after we hit a cycle low. And how is this all tying in, and what does it mean to the Bitcoin 4-year cycle? Let's dive into that in today's video as we unpack the data, just looking at the facts on the charts and the historic data. This is your home of macro cycle analysis, studying the past to forecast the future. You know the deal, hit that like and subscribe button. We're covering crypto, Bitcoin, stock markets, and the biggest cycle of them all, the real estate cycle. Now, quick shout out to our traders from the last video, smashing the fantastic gains to the upside, 500%, 248, 470, 160, 130. Guys, if you want to know more about trading short-term and long-term as we work our way into these bull markets, use a link in the top of the video description, tiacrypto.com/subscribe, name and email, and you'll be on the free email report that comes out once a week. All right, so let's crack on with the first piece, looking at the data for these cycles. Now, these are the long-term cycles, so I think it pays to continue to review them to see how they're progressing, to see whether we are on track to continue playing out the same cycles that we have seen, in this case, 120 years. So this particular cycle is looking at the markets at the end of the second year. So the years ending in 2. So the second year of the decade, 1902, 1922, 42, 62, 82. You get the gist. And then this brings it, so that's from September of that month, or basically October, all the way into the end of the 5th year. So the 5th year in the decade. So what we have covered previously is that these particular 3 years, so the 3rd, the 4th, the 5th, and then a few months from the previous year, this roughly 39 or so months has shown very good upside. So typically these are those boom years, but what we see in the media is that these are the fearful years. So we're into that 120th year. We're looking forward to the next 3 years to see how this data plays out, just like in the previous cycles. And the average return of these years, if we start a purchase at that time on that date, so basically call it the last day of September, the last trading day, and you sold on the last trading day of the 5th year in the decade. So in this case, it'll be somewhere around the last day of December in 2025. Typically, the average return has been roughly 60%, with a median being 64%, a maximum of 76%, and a minimum return here of 41%. So these are the good years, but what we see in the media is that they are usually the most fearful, because we should know by now that bottoms in the market are formed on very bad news, extreme fear. The worst news comes out at the lows, and basically, that's what creates a low. Sometimes it takes days, sometimes weeks. More often than not, it takes months, and that's what we've seen with the S&P 500 with that October 2022 low, 2022, spanning from roughly May or June, and then we had that final low in March of this year, 2023, before the market started to head that bit higher. So it was a rough 12-month period before they started to break out of 42, but we'll get onto that in just a moment. I just wanted to recap on this because we're still within this particular cycle. And so far, the data has been well and truly on track. Now, for the next piece, we're looking at the short-term cyclical trend of the year. And this is the year if the S&P has been up 10% or more at the end of June, what typically happens at this point. So we've been up from that point. We topped out here in July and have had the pullback. Like you can see from a cyclical pattern of the other years up to 10% year to date in June, they typically continue sideways, or if we're just following the swing or the movement of the cycle, there's typically a low roughly this time. So roughly late October, potentially early-ish November if it starts to get pushed out a little bit here. But what we've looked at and said before is that towards the later half of the quarter 4 of 2023, we should see the market start to push up. Call it late November or December, maybe a Christmas rally, maybe the Thanksgiving rally, whatever it may be, markets tend to push up. Because it's pulled back so far, I don't think we should expect that the market is going to break through that July top within this period, seeing as we have about 2 months left of the year. If it does, great. If not, what we're just looking out for is the movement in the cycle. We should see the cycle start to turn back up with the odd low. You can see this market paused here, a small low, another small pause and a low, another low here, but it continues to head higher. So we have the resistance on the way back up when we look at the S&P. The tops that were put in through July, August, and the most recent one here, I think that was October where that top was in. So if we do bottom here over the next couple of days, late October, maybe early November, then start to look towards the market trending up, whether it can get through those levels and keep riding up. The S&P 500 after climbing within 5% of a new all-time high. So this happened in July, mid-July, around that 19th, and it was within 5% of that new all-time high. I was posting a lot of this a lot on Twitter, Twitter X, whatever you want to call it. And from history, it shows that the market typically goes through to break that new all-time high within, the median is 46 days. Well, we've well and truly passed that. We're at roughly 100 days since the July reading here when the market was within 5% of the new all-time high. The longest period it took for the market to reach a new all-time high was 228 days. The other important information, well, the main one that I'm looking at is always the 6 and 12 months. Where is the market going to be in 6 to 12 months from now? And if we get an opportunity to buy at a lower price, then we just got to throw the probabilities on our side that the market is probably going to be higher than where it currently is. So right now we've got that blessing of 3 months in the red, 3 months down, coming back to test the previous resistance levels, potentially as support. And we actually have 11% down. So we did get to the double digits. I was looking for a single digit pullback, but well, the markets don't always have to listen. And we got an 11% drop from that July peak. The beauty about it is, well, there's a deeper correction and a better place to be buying at, well, basically cheaper prices, because all the data is still showing that we're in an uptrend, in an upcycle. The monthly swing bottoms have not broken. The cycle bottom has not broken. And as I'll get to in just a moment, looking at the longer term data here, in history, the S&P 500 has never broken back through to a new cycle low when we look at how far it has rallied up, especially in that time perspective. So if we take it back to this particular reading here, 6 to 12 months from now, 80% of the time the market is up. These ones, I think, are now out of the question. 1, 2, 3 months, that's going to be a new reading now. So these are the next one we're looking at. Could it go lower? Of course, anything is there, but we just got to throw the probabilities on our side. In this case, and I quite enjoy bringing this and putting this into the video, because more often than not, it is going to be on our side. This time, it didn't work out in the short term. I think we're going to get a more accurate reading from the longer term than the shorter term, because the shorter term, it can chop and change. The longer term is where I'm focusing my attention with this particular data. When half the bear market was recovered, stocks never moved back to new lows. This is a super interesting one, because from where we have come on the S&P 500, from this low, we have recovered 50%. So if we take out our tool, there's the market low, there is the cycle low, and there is the all-time high for that cycle. We've recovered 50%, so it was 41.55. It made it all the way back, and now we're back to those levels again. In history, once the market has done that, it has never gone back to a new cycle low. Again, I've got to throw it in there because there are no guarantees in the market. Could it happen this time? Could this be the first time it happens? Let's wait and see what happens. What I would be looking at in case that does happen, because we've always got to have a backup plan here, is this low here. The March low is the key low that I'm watching for. If the market breaks down and holds under this level here, that is a sign that we will likely test that cycle low. So we've come up, we've broken out, we've had multiple months to the upside from that October low. There was 9 months up with a 32% move from that low. Now we've got 3 months back, so still relatively short compared to the move to the upside. We've had a healthy correction so far. If we look at it in terms of 50%, we still need to get back to 40 4,050 points for the SPX. So that's going to be a key level for support as well for those monthly closes. Like I said, this is a really strong level here. That's the March low, 3,800 points. If we're to break that, then sure, I have to flip bearish and say we're probably going to test those lows. But I'm not getting there yet. The market's not there yet. We still have to test the 50% level. And I'm just bringing that up as in case of a flip. We're going to have that side of, well, is the analysis still on track or is it not? For me, it's still on track, and these are just presenting much better buying opportunities than the folks who were getting in late here after we talked about June being a low, October being a low, and March being a very, very significant low in this transitional period from a bear market to a bull market. As we looked at earlier, the bull markets always have scares at the beginning because the masses still think the market is going to collapse. That's the way the first stages always begin. The tops are when everyone thinks the market isn't going to collapse. Same sort of thing happened 2007. You had the dot-com boom. It happens every single time. When everyone is confident the market's not going to collapse, that's typically when it collapses. And right now, not everyone is confident that the market isn't going to collapse. There's still a lot of people talking about the market collapsing, which maybe isn't the case. Maybe we're putting in another higher low on a broader picture here, and potentially maybe we have a bull flag setting up. Let's see where the low comes in and follow the market from that point. So this data goes all the way back to 1956. This was when the S&P 500 was introduced as the S&P 500. However, it dates back to 1923 when there was only 233 companies in the mix. So what I did was go back through the entire history of the S&P 500, as I do, to check to see if this is actually correct when viewing this particular data. Basically looking at each of the bear markets from the peak to the trough and the decline there, and then looking at the recovery and whether the market went back to drop below that low of the trough day. So in this case, 100% of the time, the market did not, that's why it's got no there, the market did not make a new low. Could this be the one that ruins that record? Let's throw it out there as a possibility, but if we just keep going with the data, probably not. The times where it did break back past that low, so like we looked at, remember the S&P was introduced in 1957 as the 500 companies. Before that, so from 1923 up to that point, it was 233 companies. Looking at that, there were a few false signals. There was this one here from the collapse, the 1929 peak to the Great Depression low here of 1932. So that mega bear market, 90 odd percent. Remember, times then were different. Still had collapses, but they weren't printing money like they do now when we get the collapses, which is why we typically get that sort of 40 to 60% decline for the S&P 500. Whereas back in the day, 1929, you had 86%, which is why most call it, roughly that 90% collapse. They weren't coming in to support the market. So if that happened again, maybe we would see those 80 to 90% declines. But while the Fed keeps printing and they've got a lot of control over the economy, so it's not really as free as it used to be, well, we might not see the 90% like back then. So back then, we did have the reading here where it did recover 50% of the collapse and then went on to make a new low, but the time was very short. So that's one thing that is very, very different here. You had a rally of 4 months, 4 to 5 months, compared to now where we had a rally of 9 months, and then it went on to make a new low. We can take it all the way back to this cycle low, and then that's 1932. The market never went back to make a new low from that point. So I could really say that there was one time here that it didn't work out. The rest of these times where it was a false signal, so any of these arrows that are pointing down, it went back, recovered 50% of the bear market because this move down was more than 20%, and that's the bear market. There's another move that was more than 20%, and then it went on to make a new low, This hadn't reached a new all-time high yet, whereas after this point, after breaking the 1929 high, we went on to make a new all-time high. There's your correction. The market rallied above the 50% level and went on to make a new all-time high. So each of these occasions now, bear market rallied more than 50% of the bear market, went on to make a new all-time high, went on to make a new all-time high, went on to make a new all-time high, and then again, not the high yet, but it didn't break past the low. It went on to make a new all-time high, broke down, It went on to make a new all-time high. You get the idea here. New high, just to make sure we get all their data in. New high, and so on and so forth. Eventually made a new high, and here we are. 100% of the time from that 57. Can this be the time that breaks down? Let me know in the comments section. S&P 500, do you think it is going to break the October 2022 low of 3,500 points? Yes or no? That question will be pinned at the top of the video description. While you're there, hit the like and subscribe. How is this all affecting Bitcoin? That's what we're here for. BTC, well, it's breaking out to the upside. Is Bitcoin going to continue on if the S&P breaks down? Well, we've covered this one before, the Bitcoin accumulation zones. This is the S&P 500 with an overlay. What I've overlaid here with is the Bitcoin accumulation, the Bitcoin bull markets, and the bear markets. So wherever these squares are with the name, Bitcoin had its bull market breaking a new all-time high to the peak, and then the bear market essentially from that peak to the trough of that bear market. So that's why you can see these boxes are roughly the same, because it's about 12 months out, 12 months down. The accumulation's roughly 2 years. So what we haven't seen this time so far, and we're halfway into this accumulation, is a new all-time high for the S&P 500. In each of these previous cycles, so the 2015, 16, 17, and the 2019, 20, 21 nearly, we got a new all-time high using this as a resistance level, a new all-time high on the S&P 500. There was a couple of times earlier, we got the pullback, and another time, massive pullback, which is the COVID collapse, and then it even went on to a new all-time high from that point. The previous accumulation, there was a slight all-time high here. So you can see there was a move to the highs, a pullback, and then another move to the highs before we had the president election. That was the Trump versus whoever it was back then, Hillary Clinton, I think. The market went on to new all-time highs. So in each of those occasions, the S&P 500 has made a new all-time high while Bitcoin has been underneath its own all-time high. We're still underneath the all-time high. We still have roughly 11 months to go till the end of this accumulation. Of course, give or take a month or two either side. These are macro cycles, and we need to have some tolerance to the numbers themselves. But roughly speaking, we're probably about halfway through that accumulation period, or at least we've got half of the time to go before Bitcoin breaks out of its previous all-time high of 69,000. So with that in mind, we can then start to throw a couple of numbers or a couple of dates out there. If we look at roughly 11 months from now, that takes us out to September of 2024. So potentially sometime in the second half of 2024 is when Bitcoin will be above $60,000 or $70,000. Let's see how it goes from that point. But the main thing we need to look at from here is that the S&P 500 gets to that new all-time high like it has done in the previous cycles, because that's bringing more money into the financial space. And then that money, at least what we can see from the cycles, is that money looks for riskier assets. Bitcoin is that riskier asset, flows into BTC, and then of course down the line to the ETHs, to the big crypto caps, to the smaller stuff, to the degen plays, so on and so forth, until everyone is invested and those big gains happen. Some people make money, most people don't, and those cryptos collapse after that point. This is a long time off, like I've got here, those rough dates that we're looking at. With the S&P 500 dropping 3 months in a row, looking like it wants to test that 50% level, it seems like it is another reaccumulation zone based on what we have looked at in the past after the transitional phase from the bear market to the bull market. All of the info as to why this was the low was on the channel, so make sure you do like and subscribe. Are we going to see something that has never happened in history, or are we going to continue what has already happened in history with the market climbing out of the bear market by the 50% level? Will it hold above or will it break down? Let me know at the top of the comment section, the pinned comment there. I'll see you guys back here at the next one. Check out the video popping up here on your left-hand side. Until the next one, have a fantastic weekend, and I'll see you then. Peace out.